Welcome to this comprehensive guide on the ProShares UltraPro Short S&P500 ETF, or SPXU. First, let's define what an ETF is. An ETF, or exchange-traded fund, is a type of investment vehicle that tracks a particular index or asset class, such as the S&P 500 or gold. ETFs can be bought and sold just like stocks on an exchange, and they offer investors the opportunity to diversify their portfolio without the need to purchase individual stocks or assets. Now, let's dive into the specifics of SPXU. ProShares UltraPro Short S&P 500 ETF is an inverse ETF that seeks to deliver 3 times the inverse, or opposite, of the daily performance of the S&P 500 index. In other words, if the S&P 500 goes down by 1%, SPXU aims to go up by 3%. This ETF is designed for investors who are bearish on the stock market and believe that the S&P 500 will decline in value. By investing in SPXU, they can potentially profit from a downturn in the stock market. However, it's important to note that inverse ETFs are not meant to be held for long-term investments. They are intended for short-term use and can be more volatile than traditional ETFs. Therefore, it's crucial for investors to understand the risks and be prepared for potential losses. One potential risk of inverse ETFs, such as SPXU, is that they use leverage to achieve their desired performance. Leverage allows an ETF to amplify its returns, but it also increases the potential for losses. In the case of SPXU, it uses 3 times leverage, which means that it can potentially generate 3 times the return, but also 3 times the loss, compared to the S&P 500. Another risk to consider is the potential for tracking error. Tracking error is the difference between an ETF's performance and the performance of the index or asset it is tracking. In the case of SPXU, it seeks to deliver 3 times the inverse of the S&P 500, but there may be times when it does not perfectly track the index. This can result in losses for investors, even if the S&P 500 declines in value. Now that we've discussed the potential risks of SPXU, let's talk about the potential benefits. As mentioned earlier, this ETF can be a useful tool for investors who are bearish on the stock market and want to profit from a downturn. It also offers the convenience of being able to buy and sell shares on an exchange like a stock, rather than having to purchase individual assets. In addition, SPXU has a relatively low expense ratio of 0.95%. This means that investors will pay a yearly fee of 0.95% of their investment to cover the cost of managing the ETF. This is lower than many mutual funds and can make it an attractive option for investors looking to keep their costs low. In conclusion, the ProShares UltraPro Short S&P 500 ETF, or SPXU, is an inverse ETF that aims to deliver 3 times the inverse of the daily performance of the S&P 500 index. It is intended for short-term use and can be more volatile than traditional ETFs. It is suitable for investors who are bearish on the stock market and want to profit from a downturn, but it is important to understand the risks and be prepared for potential losses. However, it also offers the convenience of being able to buy and sell shares on an exchange and has a relatively low expense ratio.